And so I think what we can expect to see is that the housing market, which has been just stupidly ridiculous since about June of last year, with prices rising on average by 25%, it is going to calm down. Hello, this is Tony Alexander here again, just with a quick update on what we might see happen in the housing market, interest rates, etc., as a result of the relatively surprising announcement from the government that investors in residential property can no longer deduct their interest costs from their rental income when they're calculating what their tax obligation would be. So what I mean there is that in the past, let's say you rented a property for $15,000 and you had a mortgage, and so you were paying interest on that, and let's say the interest added up to $12,000, and let's just pretend that was your only expense. You go 15,000 minus 12,000, it leaves 3,000. You're only going to be paying tax on your $3,000 profit. So what's that, about $1,000 worth of tax you're going to be paying. Now you're not going to be able to deduct the interest at all, so you're going to pay tax on your full $15,000 worth of rent, and so at a 33% tax rate, which applies for still most people, you'll be paying about $5,000 tax instead. So this is quite a significant change. Now, when we look at what the impact might be in the market, we've got data from CoreLogic which tells us that on average, about 24% of people buying property are investors, taking out a mortgage, and about 12% they pay cash. The people paying cash won't be affected, but the other ones, some of them will be affected, and simply the return is no longer going to be there. And while for existing property owners this will be phased in over 4 years, there will be some impact. And so I think what we can expect to see is that the housing market, which has been just stupidly ridiculous since about June of last year, with prices rising on average by 25%, it is going to calm down, and I think we can reasonably expect that maybe for a few months, not the March data, but for a few months afterwards, we will tend to get prices pulling back a bit. It moves the market in favour of first home buyers, so this is relatively important. There will be less competition from the investors at the auctions. So for first home buyers, this is a good thing. The biggest problem is obviously partly for the investors who have already bought a property, and so now their cash flow is going to be affected. It's going to push up rents. If you're not getting the yield you got previously, then I think we're looking at 1 to 4 years of very strong rental increases around New Zealand. The supply of rental property will diminish as well, and so this is going to cause the government some substantial problems when it comes to providing social housing. So they're going to be helping first home buyers here to a far greater degree than any of us economists thought would happen, but they are going to create some problems there, certainly for people renting at the lower end of the socio-economic spectrum. But it does mean definitely, I think, the housing market now settles down for the rest of the year, and this is going to be good for the average home purchaser out there. The investors, it's a structural multi-year, I think, backing off that we're going to see here. And the downward movement in prices, I think it will occur, but I think it will be relatively limited. The good news, it means interest rates, less upward pressure over the next 2 to 3 years. Thanks very much.